Hey, welcome investors to the 40 Finance channel. We've obviously seen a lot of meltdown in the high growth names over the past month or so. And here on Tuesday, January 3rd, we're seeing even more. We're seeing prices come down, prices that have already fallen from a relatively high point. So there's a lot of talk, is this a buy the dip opportunity with interest rates going up? Should you wait and find out more? So for today's video, I'm just going to give you a simple kind of eyeball math trick that I've been using when taking a look at some of the beaten down names. What we're going to do is use 100 PE as a multiple on future earnings and just see if a stock sneaks below that level. The goal here is just a quick litmus test to see, is this stock on sale and how long will I have to wait for the earnings of this company to start to build a reasonable price to earnings ratio. Now, as many of you know, P ratio is not the end all be all. It's not a one trick solution that determines whether or not you should invest in a stock. You certainly have to be mindful of debt ratio, which is not incorporated into P ratio. So you always want to check the debt and the cash holdings, cash flow of the company as well. And perhaps most importantly, not all P ratios are the same. So they're generally best when compared within sectors. So for example, like in the chip sector, you could stack up AMD and Nvidia, but you wouldn't want to compare those names to something like a Disney, right? Because it's just too different of an industry and different amounts of valuation. And generally speaking, each industry slash sector has its own kind of valuation multiple that's built into the baseline. The other factor here is, of course, growth rate as well. But at least for myself here in the first part of 2022, while growth rate is important, I think that the focus being on profitability and earnings per share back to the shareholders is going to be key because it gives you a little bit of a floor. And by floor, I mean how far a stock price could fall until potentially almost everyone would agree that it's on sale. So let's jump in here and I'll give you some examples on using this 100 PE multiple looking ahead on some of these growth names. All right, we're going to kick things off with Nvidia here to use as an example, and then I have several more that we can compare against. And for this, we're going to use SeekingAlpha. I'm a premium member of SeekingAlpha, also part of their affiliate program. And if you go down to the description on this video, there's a very attractive savings offer for 1 year of SeekingAlpha Premium. So definitely check that out. But in terms of this 100 PE multiple that I'm talking about, one of the things that I use all the time on SeekingAlpha is their future earnings and revenue projections. It's just a very nice, compact. I always go down to the table view. They do this chart view too. By the way, if you are a member, I always switch over to annual. That's just my personal preference, and that's what we're going to do here. So you can look at the chart if you want to and hover over it, but I'm just as comfortable looking at the table. And what we want to apply here, or what we're really looking for, particularly with high growth tech names, is can this company beat 100 PE multiple looking ahead? So if we start with the fiscal period that ends January 2022, we see that Nvidia, the estimate right now, 433. They're likely get very, very close to that because we've almost hit that point in the year where they'll be reporting on it. That gives them a forward PE, at least over the next couple months, of a 69. So it's definitely below 100. And I think with tech stocks right now, depending on their growth rate, if you got a high flyer like Nvidia that is growing fairly quickly, which we'll find out here in a second on the revenue projections, but 100 is pushing it as it is, okay, historically. 100 PE is probably about as high as you want to see. So when we're clicking through some of these names, we want to aim for somebody who's going to slide under the 100 threshold over the next 2 years. I think that's a fairly safe spread. The key being, if you're going to get under 100 over 2 years, and let's just say you come in at 95, for a stock, you better have a 30 to 40% growth rate in order to justify a PE multiple that high. And here we are with Nvidia. If we look to the next fiscal year, which basically will turn into the forward PE whenever they report earnings, you're going to drop to a 58.42 if they hit this number, and through 2024 you might get down to 50. So at this price of 288, I'm not saying it's the cheapest stock in the world, but at least passes this eyeball test. And from here, you could dig into maybe more details to see how much a company is projected to grow over the same time period. And luckily on SeekingAlpha, you can just scroll further down on the same page and get some revenue estimates. So we see here 59% growth if they hit this number when they report their earnings. Then it kind of slows a little bit. You get down to 18% and 17%. That's still good news. But like I said, if you're going to constitute a PE of 100, then you better be in the 30s and 40s percentage on your revenue gain, or else it starts to look less attractive, particularly for value-minded investors like myself. You also note here in this table view that they do the forward price to sales calculation for you, which is very, very nice, looking ahead several years in advance. Of course, you know, the several years in advance, it is based on analyst projections, so take it with a grain of salt. My opinion would be, you know, anything beyond 2 years is just about impossible for anyone to project. So, you know, stick within a 2-year time frame, see where analysts are coming in, but beyond that, it's going to be relatively difficult to be accurate in any way. All right, let's take a look at Cloudflare. This is one that was up as high as $211. Let's just say 2 months ago or so. And if we dig into their earnings estimates, switch it to annual here, we scroll down. For the end of this past year, December 2021, they did not have an EPS, okay? Minus 5 cents is the pace that they were on, which is still decent. I mean, still 56% growth rate, but it is still negative. Let's see what we got in December of 2022. Now they're up to maybe 2 cents a share here. Now that puts your forward PE in the 8,000s, somewhere in that stretch, so obviously way off the scale. And even if you project ahead to December of 2023, or heck, there's even a 2024 in here that's coming in around 500. So if we took this 2 cents, this is where you can do this in your brain with or without any sort of service. You could just multiply this 2 cents by 100. Now, obviously, that's going to give you 2. And no one's going to let Cloudflare stock swing by them for $2, right? Or $10 the year after. But I think what you're looking at here and what you're saying to yourself is, well, can this go down further? Is 112 the right buying opportunity? Because if we see weakness, how much further could it go? And I'm not saying it's going to go to $2 by any stretch of the imagination. But what I am saying is I foresee that there could be more weakness for the stock like Cloudflare if these interest rates keep having an impact on the market. Let's take a look at their revenue numbers. So this is one where you can start to constitute maybe 100 PE, maybe even a 200 PE when you have revenue growth plus 35%, which it looks like they're in line to do between now and really the foreseeable future. But like I said, about 2 years is about all I trust out of any analyst getting correct. So the forward price to sales, if you want to go that route, incredibly high at 60 times, incredibly high. You could make the argument that buying it today and waiting to 2023 gets you more in tune to a normal. I will tell you that most price to sales outside of technology stocks are going to be sub 10. Keep in mind, in our Nvidia example, that was a stock that was trading in the 20s. on price to sales. And I believe if we extrapolate it out to 2024, you were right at that 20 line. And Nvidia is definitely a stock like Cloudflare that could outperform and do better than projections. But I would say in no way, shape, or form is 62x and 45x the floor potentially for Cloudflare. All right, let's take a look at Palantir. And we go down to this past year that just ended. If they hit, they'll land about 15 cents. Times that by 100, you have a stock price of $15. You get ahead to the end of next year, you get closer to $20 and then maybe $28 by 2023. So you can see right now they are above 100 forward PE, but that is in the short term. If they do grow their EPS, you start to sneak under 100 starting next year. Now that next year is going to come up very quickly because right after they close the books and report on 2021, everybody's going to be looking at this number. And while it is under 100, I think you have to choose wisely. And you look at the stock and you just say, you know, at $18, can it go much farther? I'm in on Palantir, I think at $21. I will be looking to lower my cost basis and add more shares. And if we eyeball the growth rate, right? Remember I said if you want to have a PE of 100 or potentially even more, you better have plus 30s on the revenue line coming through. Palantir would achieve that at 39% this year, but they're ducking under it in 2022, and then 2023 staying about 30%. So this would be one where, hey, I like the growth rate. It's solid at 30%. It's not like a whiz banger. I would expect to see PEs under 100 for a stock like Palantir, and that's exactly where it looks like it's going to fall to. All right, let's switch industries and take a look at Square. Does Square deserve 100 PE? That's a tough question. Just because it's in financial services, there's not a lot of comrades in there that are going to have high PEs, but Square does. Now, if they hit $1.69 and you times that by 100, that gives you a stock price of $169. So right now, the forward PE is under 100. Next year, right now, they're only adding 10% to their EPS. So I would say that's less than I would have anticipated, to be quite honest. But then they have the year after that starting to reach a higher level of profitability. So if they hit this 280 and maintained 100 forward PE, at some point you might have a 280 stock price. More than likely, though, what you're going to see out of Square is the actual PE coming down, the valuation or the multiple that people pay coming down, because when we look at their growth rate, huge year this year in sales, next year very mixed, come in at single-digit growth rate for next year, and they don't start picking it back up again until 2023 to get to the 20 percentile. So right now, I would say that Square still has some room to fall if we see more pressure on the stock market. All right, let's take a look at MELI, MercadoLibra. This is one that I almost bought into a couple times last year when it inched close to $1,100. And it is building profitability, and the projection is it will build it significantly over the next couple years. So if we look at this, though, for this year, if they do hit at 350, you got that forward PE of 380 at today's price. If they hit next year, $8 per share, very impressive, 128% growth on the bottom line. That's very impressive. Unfortunately, it still doesn't put you under a PE of 100, okay? Now, they are expected to have 1, 2, 3, I'm going to stop right there. At least 3 years projected today of over 100% EPS growth. That will do wonders for anyone's PE ratio. So there's a lot to think about here, but where my mind goes, at least right now, is I'd like to see MELI get a little closer to $1,000. I don't think the price is horribly unfair right now. What is this, 1,200? If we look at their sales numbers, they're plus 35 over the next couple years. That's definitely a good sign. And the price to sales is very comparable to what you would find to like an Amazon. So the numbers aren't bad. I just think that you could make the argument that a run down to 1,100, maybe slightly under 1,100, might be a more comfortable place for this one. The bonus I'll give MELI, though, is this earnings per share outrageous growth on the bottom line. All right, last one we'll look at here is Tesla. A lot of discussion about Tesla, always a lot of discussion about Tesla. And again, we're going to use that 100 PE and see if we're in a buy zone right now. And just looking ahead to the EPS estimates, let's just start it next year. $8.98. If you times that by 100, that would be $898 a share. So it is over that forward PE mark of 100. And even into 2023, now you get closer, right? You get closer. You get to 1150 on the shares. What are we at today? Basically that. So if you're going to hold for 2 years, I would say right off the bat, you're almost at par for Tesla, the way that they have been outperforming. And if you assume they will continue to outperform, may not be a bad bet. Let's see how price to sales are going. They are dropping significantly as well. And you have that high multiple growth. So 65% this year, plus 40 next year. My guess is if they stay on their current trajectory, then December 2023's numbers are going to end up over plus 30. That gets you down to price to sales, not quite below 10, but at 12. So would I go on the record and say Tesla's a deal at 1150? I would say that their recent outperformance has really started to catch up to where their valuation is now today. I personally would probably want to see it under $1,000, but that's just looking at it straight from a stock perspective. I don't own Teslas. I don't desire Teslas in any way. So I can understand if you're a fan, how you would pad those numbers a little bit. Okay, guys, so that's the simple 100 forward PE test. You can apply it to almost any stock. Find out what their earnings are projected to be, whether you use SeekingAlpha. Don't forget the discount in the description. You can find them on Yahoo Finance. You can find them in a lot of places. And just multiply it by 100 and see if indeed your stock would fit under that. And here's a quick tip. If you don't have an EPS, if you multiply 0 or negative times 100, the results are not going to be good. They're not going to pass the sniff test that I'm proposing this idea for, right? So it's just one way to look at things. As we see the prices come down in the stock market, we ask ourselves, is this a good deal? This stock's down $100, $200. Is it a good deal now? At least you can come in here and very quickly throw it up times 100 on the EPS and kind of see where you land. Compare it to other companies in the same industry. How's the cash flow? How's the cash on the balance sheet? These are all important questions. You could go on for days, but the point of this is just to give you something to think about that's very easy to do as you're just clicking through stocks on your phone or perhaps on a website. All right, guys, hope you enjoyed this idea. Please give a like, subscribe to the channel if you did. Thank you very much for your support. We'll see you on the next video.